And all but two S&P sectors rallying today. And our next guest is looking to one area in particular to confirm the market's overall strength. Joining us here, Post 9, Strategas Research Partners Chief Market Strategist and Partner is Chris Verrone. Welcome back. It's good to see you.
Great to be here, Scott.
If we were overbought or close to it last week, what are we today?
Yeah, I think that's the challenge of the next couple of weeks, really separating the tactical call, which is overbought, with the more strategic view that, hey, in evaluating the character of this rally off the lows, we've seen some good things. Namely, finally, the internals have expanded here. Something like 60% of the S&P is making a one-month high today. That is generally in the ballpark of what you want to see to kind of confirm durability of an advance. I think, secondly, financials never really deteriorated on the way down, and they've led on the way out here, as have industrials. So two of the, what I would say, three important sectors are in gear. I think the remaining question is, can we get discretionary back in the fold here?
That you'd say that's the biggest question for confirmation.
Yeah, if you look historically, the two sectors with the highest correlation to the market itself are discretionary and industrial. So to get both in gear is really confirmation that the market has new highs on its mind. So I think especially discretionary here, given that it's rate sensitive, given that it's been in the crosshairs of all the trade and tariff talk, to get discretionary back in the fold would really be kind of the trifecta of the three sectors we care about.
Aren't all tactical calls of last week, they're like obsolete now, right? I mean, who cares about them now? We just reset the goalpost, didn't we?
Yeah, well, I think certainly if you look at the internals, we have probably reset the goalpost here. And, go back 4, 5, 6 weeks ago, all the conditions were there for a very good rally. The key in those oversold rallies is, does it have the character that you typically find in the longer term advances? And I think more and more, certainly this advance is checking those boxes. What the next couple weeks looks like is challenging. When you've seen these big expansions in 1 month highs, the next 3 or 4 weeks can be a coin toss, totally random. The next 3 and 6 months, generally pretty positive.
I feel like, though, yes, but one was based more technically speaking, and this particular time now might be fundamentally based. We've cleared, as I've said, the fog in large respects to allow the fundamental backdrop of the economy to be better than it otherwise might have been. We got so oversold that we were due for a technical bounce. But now if we can add fundamentals to the picture, doesn't that matter more?
Well, let's think about two things in that respect. So the S&P's up about 20 off the lows. 17% of that advance came before we had the clarity of Sunday. Right. So if we're thinking about the market as a discounting idea here, certainly had most of the strength before that. I think, secondly, the credit conditions and the financials really never confirmed all the recession fears out there. So if you look at the last 4, 5, 6 weeks, when I think the general view on the street was this was an oversold bounce, but in a deteriorating macro environment or deteriorating
like a bear market bounce you kept hearing about.
But financials pushed back on that and did credit. I mean, credit as of last week was basically back at the tights. So you never got that confirmation that there was an economic event playing out. So it looked more in that respect like a 98 than it did, say, a 07 or a 2008.
Well, of course. And then the data itself confirmed what the market was probably telling it, that we weren't as close to an economic calamity as much as some thought, right? That the most recent jobs report confirmed that. So we're not falling off a cliff.
Yeah, and I think that's been the leadership message as well. When you have industrials making new relative highs, it doesn't sound like an economy that's on the cusp here. Financials, I mean, the bank stocks in particular, look at Bank of New York, look at Wells Fargo, look at Goldman Sachs.
Look at them all today. They're
basically back at the highs.
And private equity's finally moving.
So it was the one part of the market that really never confirmed all the consensus agitation about where the economy would go from here. I think the question moving forward, we got to watch the 10-year yield here. That's the one thing out there. I mean, we're back to this 445, 450 range. Above 460, you begin to raise an eyebrow. At what level do rates actually start to work against you?
How do you think about that question? Because, again, we're back to, well, okay, it's okay. Rates are moving up now because we've eliminated the worst-case scenario out of the picture, and now the economy is going to be just fine. And you know what? The Fed, now that's pushed off till September, so we're not getting any cuts anytime soon. This is going
to be a pretty unsatisfying answer. But when you look at the last 2 years, the only correct call on rates has been no call. You've been in a range for basically 2 years. I think to push up and out of that range, you're talking above 460, 465. Above that, you begin to wonder, okay, is this going to work against the consumer now? I find it curious. The home building stocks are outperforming a touch today, but they're not as dominant as other parts of consumer is. When you look at discretionary in aggregate, where has the strength come from? travel, airlines, cruises, not necessarily your durables. I think it's important we watch the durables here if they start to respond negatively to higher yields, and then watch these banks. They've been so good, but if banks start to work against you with rates up, that's not the best message out there.
Yeah, housing's up.